Investor home purchases just crashed to their lowest level since 2020. We're talking a 6% year-over-year plunge in Q1 2026 alone, according to Redfin data released last month. Even before the pandemic, you'd have to go all the way back to 2016 to find investor activity this low. So what's really going on here? Is it simply high mortgage rates finally pushing even the pros out of the market? Or is there a deeper shift happening under the surface? Because for years now, we've heard about the institutional money, the Wall Street giants scooping up everything. But the truth is, most investors are still mom-and-pop landlords. And they're the ones feeling this squeeze the hardest. This isn't just about headline numbers. It's about the math simply not working anymore in a lot of markets. We'll break down the specific metros where this collapse is most severe and what it means for first-time buyers and existing homeowners heading into the back half of 2026. All right, let's talk about investors, because the narrative out there is messy. You hear about Wall Street giants buying up everything, but the data, when you really dig into it, tells a different story. Redfin just reported on May 28, 2026, that U.S. investor home purchases plummeted 6% year-over-year in the first quarter, hitting their lowest point since 2020. Before the pandemic frenzy, you'd have to go all the way back to 2016 to find investor activity this subdued. And get this, even with mortgage rates slightly easing into the low 6% range in Q1, a welcome dip from the near 7% peaks we saw, those rates are still double what they were during the pandemic lows. This isn't just a blip. It's a significant recalibration driven by the hard math of what actually makes a deal work. We're going to unpack why these purchases are collapsing and what it means for everything from rental markets to your own home equity. That you'd have to go back to 2016 to see investor activity this low. But here's where the narrative gets tricky and, frankly, a bit contradictory, depending on who you're listening to. On one hand, we have Redfin, specifically their lead economist Daryl Fairweather, who, just last month, May 28, 2026, reported that U.S. investor home purchases plummeted 6% year-over-year in Q1 2026. That's the lowest level since Q3 2020, and even before the pandemic. You'd have to rewind to Q4 2016 to find investor activity this subdued. They attributed this significant pullback to the twin pressures of elevated housing costs, with the median U.S. home price reaching $420,000 in early 2026 and stubborn mortgage rates, currently hovering in the low 6% range for a 30-year fixed loan, effectively squeezing out potential returns for flippers and rental property owners. In Q1 2026, investor purchases made up 16% of existing home sales. A modest bump from the prior quarter, sure, but a clear drop from the 18% market share they commanded a year earlier. Then, you have other data points telling a seemingly opposite story. Batch Service, in their October 1, 2025 report, claimed investors were buying a staggering 33% of U.S. homes, citing robust activity in Sun Belt markets like Phoenix and Atlanta. And Rebecca Picciotto of the Wall Street Journal, back on July 27, 2025, even highlighted a record high of 30% of single-family home purchases by investors in the first half of 2025, a period where overall home purchases fell to a 30-year low. Even Cotality, on August 28, 2025, noted a slight dip in Q2 2025 investor activity, but emphasized it remains elevated, with 32% of single-family purchases in January 2025 being attributed to investment firms and private equity. This isn't just a minor discrepancy. It's a fundamental split on whether investors are pulling back or surging forward. So, who are these investors, really, and what exactly are they buying? Have to go back to 2016 to see investor activity this low. But here's where the narrative gets tricky and, frankly, a bit contradictory, depending on who you're listening to. On one hand, we have Redfin, specifically their lead economist Daryl Fairweather, who, just last month, May 28, 2026, reported that U.S. investor home purchases plummeted 6% year-over-year in Q1 2026. That's the lowest activity since 2020. So, who are these investors, and are they really the bogeymen buying up every single family home in sight? The prevailing image of deep-pocketed institutions dominating real estate is, frankly, often misleading. When we talk about investors, the majority are what we call mom-and-pop landlords, typically owning between 3 to 10 properties. These aren't the BlackRocks or Vanguards that get all the headlines. In fact, as of Q3 2024, investor activity only showed a modest 2% uptick from mid-year, with the investor share anticipated to hold steady around 25% of total sales. This is largely due to sustained high mortgage rates and elevated home prices simply squeezing potential returns. The Wall Street conspiracy theory, the one suggesting large institutions will intentionally crash the housing market, is something Redfin's chief economist, Daryl Fairweather, explicitly refuted on April 22, 2026, stating it doesn't hold water. Yes, institutional investor interest did spike significantly between 2020 and 2022. That period saw cheap money and Federal Reserve stimulus driving home values up nearly 40%, as Joshua Barone detailed on September 16, 2025. It made sense for large funds to chase yield then. But as mortgage rates doubled from pandemic lows into the low 6% range in Q1 2026, acquisition costs soared, and profitability for both rentals and flips diminished. This directly translates to shrinking returns, which is exactly why we're seeing this pullback. The primary driver for this pullback isn't just a lack of interest. It's a stark reality check on the numbers. Elevated housing costs are squeezing potential returns to a point where the math just doesn't work for many investors anymore. Think about it. Mortgage rates in Q1 2026 were hovering in that low 6% range. Now, that's a slight dip from the nearly 7% we saw in late 2023 and early 2024, but it's still double the pandemic-era lows. That alone significantly increases borrowing costs. Couple those rates with home sale prices that continue to climb in most metros, and you have a double whammy for investor acquisition costs. Redfin's report from May 28, 2026, highlighted this perfectly, noting that rising prices are directly reducing profitability for both rental properties and flips. The era of cheap money, which fueled that institutional investor surge we saw between 2020 and 2022, effectively ended when the Fed adopted its higher-for-longer stance. That move, in essence, doubled borrowing costs overnight for many. Let's put it into a real-world scenario. Say you were looking at a single-family rental in Tampa. In 2021, you might have secured a 3% mortgage on a $300,000 home. By Q1 2026, that same home is now $420,000, and your mortgage rate is 6.2%. Your principal and interest payment has jumped from around $1,265 to nearly $2,600, not even accounting for taxes and insurance, which, by the way, are through the roof in Florida. That massive increase in acquisition cost and borrowing rate means your cap rate shrinks dramatically, and your cash flow, if it exists at all, becomes razor thin. This is why Glenn Kelman, CEO of Redfin, often talks about how the lock-in effect is hitting both homeowners and investors. Nobody wants to give up those low rates. These combined factors of increased acquisition costs and higher borrowing rates translate to less favorable cap rates and reduced cash flow for rental properties, making new investments far less viable. It makes sense why investor activity, especially from those smaller mom-and-pop landlords who make up the bulk of this market, has been pulling back. And this isn't just a recent phenomenon. We're seeing a sustained trend. You see, while Q1 2026 data shows investor activity at its lowest since 2020, Redfin actually noted that to find similar investor apathy, you'd have to rewind all the way back to 2016, pre-pandemic craziness. This wasn't some sudden collapse. Remember Hannah Jones's Realtor.com investor report from June 10, 2025? It highlighted that while investor buying in 2024 was slightly up from previous years, it never came close to its significant 2022 peak. In 2024, investors were snagging about 13% of homes, a higher presence than the early 2010s, but certainly not the fever pitch we've seen more recently. This aligns with what Ingrid Gould Ellen and Lori Goodman from the Hamilton Project pointed out. From the 2010s right up to 2021, the growth of investor-owned single-family homes, SFRs, really stalled. It was almost like we were treading water, just returning to pre-2008 crisis levels. For example, during that period, you just didn't see the rapid absorption of inventory by investor groups that became commonplace later. It was a slower, more deliberate market. Fast forward to Q3 2024, and investor activity only saw a paltry 2% uptick from mid-year, reinforcing this idea of slow growth. Compare that to CoreLogic's finding that investor transactions, which peaked near 30% of sales in early 2024, dropped to 23.4% by June of the same year. That was the lowest share in 2 years, and it shows you how quickly market dynamics can shift when the math gets challenging. So, what exactly does this historical context tell us about what's next for the housing market? So, what does this all mean for the housing market moving forward? Despite these current fluctuations, we're not seeing a mass exodus. In fact, the investor share is actually expected to remain robust, hovering around 25% of total sales. This isn't just a guess. It's a reflection of persistently high mortgage rates and elevated home prices that continue to sideline individual buyers. Remember the reckoning that Joshua Barone described back on September 16, 2025? He wasn't talking about a crash, but an adjustment period, a recalibration after the rapid appreciation we saw pre-2022. Even though Redfin, on May 28, 2026, noted that Q1 investor activity was at its lowest since 2020, it's crucial to understand that even with that dip, investor involvement remains elevated compared to pre-pandemic years. This hints at a new baseline for investor participation, where they're consistently a larger piece of the pie. For example, in the first half of 2025, investors bought a significant 30% of all homes, according to an article published February 12, 2026, by National Mortgage Professional. This wasn't because they were snatching everything up. It's because overall home purchases were at a 30-year low. Investors, particularly those mom-and-pop landlords who own 3 to 10 properties, the majority, not the big institutions, are simply stepping in to fill the void left by retreating individual buyers. Think of it this way. While the music has slowed, the dance floor isn't empty. Investors are still finding deals, albeit harder to pencil out. In Q1 2025, investor purchases accounted for 16% of existing home sales, a rise from 15% the prior quarter, according to HUD PD&R data, illustrating that even with a year-over-year drop, the quarter-to-quarter trend had some upward momentum. This isn't a market that's collapsing. It's a market where the rules have changed, and different players are adapting at different speeds. The question isn't if investors will be a factor, but how their strategies will evolve in this higher rate, higher price environment. Lowest activity we've seen in years. So, while the headlines might scream collapse, the underlying data tells a more nuanced story of recalibration. What we're seeing isn't a wholesale retreat from the market, but a strategic shift. The high cost of capital, those 6% mortgage rates in Q1 2026, coupled with persistently high home prices, are making the quick flip or the low-yield rental less attractive, particularly for larger institutions. However, the Redfin report from May 28, 2026, also reminds us that mom-and-pop investors, who own between 3 to 10 properties, still comprise the majority of the market. These aren't the players chasing 15 to 20% IRR on institutional-grade portfolios. They're often local operators, far more resilient to slight margin compressions and less prone to pull back entirely. The investor share, even with these adjustments, is expected to remain around 25% of total sales, a persistent force. This isn't a market collapsing. It's a market adapting, where traditional profitability models are being stress-tested and in some cases, redefined. Have you adapted your investment strategy due to these rising costs and changing market dynamics? Share your experience in the comments below. What's working for you in Q2 2026? Make sure to subscribe to stay ahead of these crucial market shifts, where we break down the data to give you the clearest picture. And if you're curious about how these investor shifts might impact rental markets, Check out my deep dive on Q1 2026 rental yield compression in the Phoenix Metro next.